Sometimes in sales and other presentations, annuities and pensions are presented as if they were exactly the same things. And indeed, there are a number of similarities. So for example, number one, they both can be used to provide for retirement income. Number two, they're both fully or partially taxable. The IRS always gets a piece. Number three, both of them have some restrictions on the accessibility of funds. Your age would be one example of that. Number four, once an election or a settlement option is made, that option is usually irrevocable. It's set in stone for all intents and purposes. Number five, they both have similar payout options. So for example, they could be taken as a lump sum or in installment payments. In addition to that, pensioners and annuitants can select survivorship options in order to designate basically beneficiaries when the primary payment recipient dies. Number six, if an installment payment option is selected, those installment payments usually persist for life. Number seven, in the case of both the pension and the annuity, those lifetime payments are often referred to as guaranteed income. But number eight, the reality is both payments can be lost, or at least they can be threatened, which number nine shows that both pension plans and annuities are susceptible to market forces. But number 10, there is a safety net for both of them. But even with some of these similarities, the devil is in the details. There are slight differences, and in some cases there are fairly major differences. And I'll sketch 10 of those also. So the fundamental difference, the one we're going to come back to again and again, number one is, let's call it the source. A pension is provided by an employer. Whether it's a private employer or a government agency, a pension is provided by the employer. An annuity, on the other hand, is an insurance company product. So number two, the primary guarantor of the pension is going to be the employer or whatever third-party company the employer hires to provide the benefits. On the other hand, an annuity is going to be guaranteed in the first place by the strength of the insurance company. But as I mentioned, there is a safety net in place, and it's different in both cases. So think of it as a guarantor of last resort. In the case of the pension, that's going to be the PBGC, or the Pension Benefit Guaranty Corporation, which has a rather odd status. It's a federally chartered corporation, and that's different from the guarantor of last resort in the case of annuities, which is basically going to be a guarantee association that is a state-level operation. Number three, there's a difference in terms of how both are funded. So a pension is going to be funded primarily by the employer. An employee may make some contributions, and on the other hand, a private annuity is completely funded by the person buying it. Now there are differences. A person can buy it with a lump sum payment or with many different premium payments in installments over a period of time. But if you're going to buy an annuity, you're on your own. Number four, they're going to differ also in terms of how the money is managed. So in the case of the pension program, again, the money is going to be managed by the employer. It's going to be managed by whatever company controls the benefits. And in the case of the annuity, it's going to be managed by the insurance company again. Number five, there's a difference in terms of the controlling agreement. With respect to the pension program, it's going to be your employment agreement. It's going to be the benefit package. And in the case of the annuity, it's going to be a contract with the insurance company. Number six, vesting is also going to be an important difference. Now this is going to apply to pension programs. Vesting occurs when you have full access or ownership to your retirement funds. In the case of a pension, there may be minimum service year requirements that have to be fulfilled before you are considered vested. Vesting can be two-tiered. If you have contributed some funds to the pension program, then you are generally going to be 100% vested in those from day one. So what we're referring to is the portion that your employer contributes. On the other hand, with an annuity, since you're the only one contributing money, you are in full ownership of that money the entire time. With the asterisk, of course, that there are restrictions in terms of accessibility that have to do with your age. There may be surrender charges, there may be other fees, and things like this. Then number seven, even though we said that both pensions and annuities have similar payout options, here again there are slight differences. One main difference is going to be this. With a pension program, generally the pensioner is going to be a single individual. But with an annuity can be set up so that there are joint annuitants. Number eight, There's going to be differences in terms of eligibility. Once again, sometimes these differences are slight. With a pension, once you have your service year requirements fulfilled, you can often access funds penalty-free after the age of 55. With annuities, you usually have to wait until 59 and a half, and that is imposed by the Internal Revenue Service. But with the pension program, some of the eligibility will be determined by the specifics of the pension program. I have a video on the Rule of 85, which is a common way that the pension eligibility is assessed and calculated. And number 9, an extension of the eligibility requirement differences is going to be this. With a pension program, you have to be retired. At least, let's put it this way. If you're working for Acme Corporation and you have a pension with Acme, you have to be retired from Acme in order to access your pension. On the other hand, with an annuity, you may or may not be retired from Acme. It's not like the insurance company is going to require that you be retired from your 9-to-5 job before you can settle your annuity. If you are of the age that allows you to access the money penalty-free, you're free to do what you will. 10th and finally, one of the biggest differences is going to be how the amount of the payments is calculated, how the amount is actually ascertained. Now, this is going to be highly detail dependent. It's going to depend on the particulars of the employment agreement, the particulars of the annuity contract, but in general terms, a pension basically takes 3 facts into consideration. Number 1, your service. How long have you been with the company? Number 2, how much did you make when you were with the company? And it's usually something like your average salary over the time you worked for the company. And number 3, there's often an additional multiplier that's added into that calculation. With an annuity payment calculation, the factors are basically these. Number 1, how much did you put in? What's the principal? Number 2, what is your mortality estimate? How long do they expect you to live? And number 3, what are the current assumptions? What's the interest rate environment? What are the market factors like? In summation, the 2 instruments are very similar. Both of them are able to provide lifetime streams of income in principle. In retirement, usually, if I had to boil the differences down, it would probably come down to this distinction. Pensions are all about the employer, and annuities are all about the insurance company. Now, in addition to that, we could also add that pensions are sometimes a bit simpler in the sense that they don't have a lot of options that you have to mess around with. So the employer often funds it, the employer selects the money management options, the employer gives you the election options, and all you have to do is serve your time with the company and choose whichever option you want to select. On the other hand, the annuity comes with a lot of different options. It's your money, it's you having to select a product, it's you having to select a funding type. And there are a number of different options with annuities that don't even arise with the pension. So an annuity can either be an immediate annuity that you fund with a lump sum, or it could be a deferred annuity. And you could fund a deferred annuity either with a lump sum or with installment payments. You make premium payments over the course of many years. With a deferred annuity also, you can select the kinds of accumulation options you want. So it might be a fixed interest rate, you might have an indexed annuity, you could have a variable annuity, and so on. So with the added complexity that the annuity has, it also gives you a little more options. So you might say the annuity has an advantage in terms of flexibility, but a disadvantage in terms of simplicity. The pension, on the other hand, has an advantage in terms of simplicity and a disadvantage in terms of flexibility. But if you found something of use in that very brief overview, I ask that you like the video. If you would like to see future content, I invite you to subscribe to the channel, click the notification bell to be alerted to new content as it becomes available. I thank you so much for joining me today, and I look forward to seeing you again in another video. Thank you so much.